Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. If you are new here, make sure to hit that subscribe button as hard as you can because I'll be here helping you navigate through this market every step of the way. This video is going to focus on the S&P 500. We're going to take a look at the broad technical picture, then take a look at some of the other markets that could influence the stock market that are big turning points like the US dollar, and of course the bond market that's been performing quite well over the last few trading sessions. We're going to discuss what that means, how it could affect stocks, and how we can take advantage of all that. So now, without further ado, let's get right into it. So let's begin by taking a look at the S&P 500. That is just looking fantastic here. A very bullish technical structure. We've had two tests of support, right? We were looking at this price channel and this longer term level of support. And remember what that corresponds to. I've just zoomed out of this chart here. This is really a bull market price channel that we broke out in March. We were watching that. That was a huge bullish development. And now we've back tested that. So that's just fantastic bullish price action. Our trade setup from our buy the dip post on gameoftrades.net remains active, and we'll continue to be making updates every step of the way as we hit our targets. If we need to book profits, if we need to raise our stop loss, make sure to go subscribe to our service if you haven't already. But we can't just look at the price action on the S&P 500 to determine where it's going to be going. There's a lot more that goes on behind the scenes than just the S&P 500 price action. And the first thing I want to discuss is the bond market, and more specifically treasury bonds. So this is the ETF TLT, and it's essential to look at the bond market if you actually want to have an idea of where stocks are going. There's just no other way of doing it because these are the two biggest assets in competition to one another. It's stocks and bonds, and they have a very intricate relationship between one another. But in general, in the environment that we're in, let's zoom out on this chart. In the environment that we're in, if we put up the S&P 500 in comparison with TLT, and we actually go to a weekly chart to see that relationship a little bit better. This is something we've discussed many times on this channel, so I'm not going to dig too deep into it, but there is a very strong inverse correlation between the stock market and bonds. Now, part of the reason for that is because stocks go down when investors think that there's deflation. Like in 2008, there was deflation, so stocks went down. And in a deflationary environment, bonds go up because that's the safety. But the other influence is also simply that there's only a set amount of money in the system, right? Especially big financial institutions, and they have to decide whether they allocate that to bonds or whether they allocate that to stocks. And so that's what gives that inverse relationship between stocks and bonds. So coming back to a daily chart of TLT, if we can figure out where TLT is going, maybe that'll give us an insight of where stocks are going. So I'm going to add the MACD on this chart, and I'll be very honest, this is starting to look like an improved technical structure on TLT. It's starting to look like we may be getting some type of a bottom here in TLT. We're getting a MACD crossover here at the zero line, right? If we zoom out, can we see a similar type of situation right there? Very similar type of situation, a bottom, a higher low right there, and a crossover on the MACD. So that led to a nice rally in TLT. So could we see that? Perhaps. This is not something that we're predicting because TLT is still below major resistance. So this is just something that I want you guys to be aware of, that if we start breaking above the $140 level, right, which acted as resistance right there, if we start breaking out above that, we might start to see a little bit more turbulence in the equity markets. And honestly, this is just my personal bias talking, but that would not be surprising to see a rally in TLT as we see the market reaching a consensus on inflation, right? Everyone is expecting inflation, and in that type of environment, you see bonds go down. And we know that when the market reaches a consensus, it's often wrong, or at least wrong in the short term. So we might see a bounce because of that. But again, just from an objective standpoint, nothing to really worry about until we start to clear the zone right there. So still a bearish bias on TLT and a bullish bias on stocks. And by the way, if you're so far enjoying this video, you like the way I'm presenting the content, the different charts we're looking at to predict the markets, and you want to continue seeing that type of content, hit that like button as hard as you can to support the channel. It is greatly, greatly appreciated. Now let's take a look at DXY, which is also in a very weird type of situation right now. I want to just give you guys the broader outlook, zoom out to a weekly chart, just for you guys to see this support level. And we recently just posted a tweet highlighting this, just a very, very simple technical analysis here. A strong level of support. If that gets broken, if that gets cleared, we're going to see a major leg down in the US dollar, and that's going to be pushing stocks, precious metals, and pretty much any asset class higher. So that's what we generally think is going to happen in the long term. We have a strong bearish bias on the dollar. But if we zoom in to what's happening on the 8-hour chart, we're starting to see the dollar make sort of a wedge pattern here. Let's zoom out and I can put the RSI on, and we're seeing the price make lower lows while the RSI is making higher low. And what that means is that if we get a breakout above this line, if we get this type of move, you can expect a rally in the dollar. And so that would put pressure on gold. It would put pressure on stocks a little bit. So that'd be another risk that we're looking at for equities, would be a breakout of the dollar. Now, that's if we get a breakout. Right now, we're still in a clear downtrend. There's no reason to start panicking. And in that case, what we'd want to see is an impulsive breakthrough this level right there, this long-term level of support. And with the RSI getting into oversold and burning through those divergences. Because if you get that type of move, then that negates those potentially bullish technicals and transforms them into very, very bearish technicals. And while I wouldn't talk about that in most other scenarios, when you get to these types of long-term levels, such a significant area of support, you can get that type of move. You can get a very, very impulsive sell-off that gives you that long-term sell signal on the dollar. So that's just something to watch out for right now. We don't have high convictions on the dollar right now until we see a break to either side, and that's going to determine the next big move for the dollar and whether or not we're going to see much higher highs in stocks. Now, we've made a recap on everything that's going on around the stock market, everything you should be watching out for. It's still looking great, and this breakout is looking very bullish and healthy, but you always have to be watching out for those developments on other markets that may impact your trade. So that's exactly what we're doing. But now I'm going to get to the interesting part, and that's going to be discussing the melt up scenario. And we're going to take a look at a couple of charts that might suggest that the markets are getting closer to a massive melt up. And this is something that we've been talking about for quite a while. The first time we mentioned a potential melt up was back in June here. But if we zoom out to a longer term chart, we can now see that the melt up scenario is actually within the cards from a technical standpoint. Until very recently, we always had that resistance kind of put a roof on the types of gains that we could see on the S&P 500. Now we've cleared that long-term level. We're above it. So the sky's the limit in terms of the kind of returns we could see on the S&P 500. Now, melt-ups don't just happen randomly, right? You need a specific set of factors that contribute to the market melting up. This is not just something that we're throwing around randomly just to sound interesting. This is actually something that we think could happen. And one of the reasons is on this chart right here. So this is the NAAIM exposure index. And what it gives you is an indicator of whether or not money managers, so active institutional money managers, are long or short on the markets and how much exposure they have to equities. And this actually tends to be a very good contrarian indicator, meaning that significant bottoms in this indicator often correspond to significant bottoms in equities. And you can see that's the case over and over again. We had two significant bottoms here in 2005 15. And so money managers actually tend to be on the wrong side of the trade. And you can see where we're currently at. We're very low on that reading. Now we're not at the green line just yet, but we're very low. And unlike pretty much any of those readings, except for a couple ones here, we're getting this reading while the markets are at all-time highs. So that's a very weird thing that's happening. If all of a sudden active money managers decide to get back into the markets, perhaps that could trigger a powerful move up. And I want to show you this other chart here that actually gives you the institutional cash that there is in the system. That's money that is not invested in equities, but could be invested in equities. So potential investments, right? Because that's what money managers want to do. They want to invest their cash, especially if you've got a dollar that's crashing. If we begin to see DXY break that support we just talked about, money managers are going to want to place their cash. And you can see what's happening here. We're seeing the amount of cash that's on the sidelines rise to similar levels we saw back in April and May of 2020. So very close to the bottom of the market. A lot of cash on the sidelines. Perhaps that's a result of excess easy monetary policy. But either way, this is a very weird thing to see when stocks are at all-time highs and significantly increases the odds of seeing a market melt up if we see the right type of development. So a breakdown on the dollar, bonds continue selling off, forcing all that cash into equities and triggering that melt up. Now, that's about all I wanted to say in this episode. I hope you guys enjoyed. If you did, make sure to drop a like and subscribe to the channel if you haven't already. In the meantime, good luck on your trading and see you next time.